event where we unpack evaluating multifamily deals, doing due diligence on multifamily deals one step at a time. For those who may be meeting me for the first time, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor and entrepreneur. And today I advise family offices, high net worth individuals on risk mitigated investments in apartments. I also work with private investors who are looking to diversify their portfolios, and I help connect them to cash flowing investments in apartments. And last but not least, for those willing to do a deeper dive in terms of vetting deals, I have a community that also comes with a self-paced course and a ton of other resources where we unpack each deal. And I help my students, now alumni, learn how to effectively and efficiently analyze deals. So without further ado, let's go ahead and get started. I appreciate all of your feedback and comments, and based on popular demand, I decided to do another live deal case study. Now, for all the deals that I do, typically I don't share addresses, names, locations for confidentiality purposes, and those are all done within the last 12 months or so. So relatively recent, done or reviewed over the last 12 months. But I want to share them with you, not only based on your feedback, but I found that we also learn through example the most. And these are real-time case studies that you can glean insights into and decide how to apply them within your own investing journey. So if you are watching, type in the chat your questions as we go along. This allows me to connect with you better. There is a bit of a delay between the streaming platform and LinkedIn or YouTube, depending on where you're watching from. But type in the chat where you are tuning in from today as we go along. So this particular deal was a multifamily property. It was presented to a capital partner by an experienced sponsor in a growing market. And the capital partner who reached out to me for help in reviewing the deal was a bit hesitant. It was their first deal of their size, not necessarily first real estate deal, but first deal of this size, first time working with that sponsor and first time in that market. So they wanted to have that second set of eyes to peel the onion on the numbers and the underwrite. And so as we started unpacking the deal, there were a few things that immediately caught my attention. I'll start with the big one, and I actually see that quite a bit happening today across a number of deals, and actually share those observations during my last live event. And if you'd like to get the link to that, simply send me a DM. But it's cap rate compression. So the sponsor had assumed that the cap rates for that particular market, given its strength, will decline. Now, we don't know where cap rates will be. We don't know where interest rates will be. None of us have really that crystal ball, or at least no one that I know of, myself included. And so just one slight tweak in the cap rates changed the LP returns from high double to low double digits. And as I've discussed in many other calls, cap rates have a pretty potent impact on the valuation and therefore the exit valuation, and therefore the overall return of the property. Secondly, and that was another big one, based on the CoStar reports, market comp data at that time, that particular market was going through an oversupply, which then contributed to a decline in rents, or at best flat rates. And that particular deal had assumed rent growth in year one. Again, realistically, any sponsor or operator taking over a property will not just be sitting behind hoping the market turns around. They'll be actively marketing the property, looking to add value and therefore increase the rents. But oftentimes we do have to take that market in consideration. And so in that case, there was a pretty sizable gap between the rent growth that that particular sponsor was assuming and where the market was today. And so my recommendation in that case was to really dial in on the comps and really understand the story there. Why do we believe this is plausible? Why do we believe this is realistic, and not just inflating rents to hit a specific target return that investors will be expecting. Now, the other thing with respect to rents was that a lot of the comps in that selection were Class A property, and the property itself was more like a Class B. So again, there wasn't a lot of clarity other than higher rent inflation on why Class A comps were selected. So again, really dialing in on the comps was one of my recommendations there. There was no stabilization period factored in, and I invested in a number of properties. I financed a lot of them in my prior life as a lender. And I can tell you that it's very rare that you go from zero to hero. There are always challenges with the transition. Some are relatively minor, some are more major, but there is always a transition time frame that owners, operators go through. And in that case, the assumptions had forecasted business as usual. And again, that may or may not be the case. And in those cases, I would probe a little bit further to see perhaps how other properties in the portfolio have gone, or similar types of acquisitions, to really dial in. Again, back to the question, is this realistic or not? And if there's sufficient data, examples from that particular operator's experience in that particular market, maybe there is a good story there. But that certainly raised the question right off the bat. The debt was fixed, which was positive. Low leverage was under 70%, which was another positive. The capex reserves were decent, about 8% or so. I typically would like to see a number closer to the 10%, but again, if it's a newer property or maybe you're not doing as heavier of a lift, I could possibly get comfortable with a different number. Again, that was at the time. In today's environment, with everything else happening in terms of inflation and interest rates and all of that, which impacts cost of financing, cost of labor, cost of materials, all of that, that's a number you really want to dial in, because again, if to the extent there are surprises down the road, then you have to dip into either the rainy day fund or finance them out of cash flow, or potentially pause or reduce distributions depending on the severity of the variance and how much needed that capex project is in particular. And last but not least, that's another one that I look at very closely. That's the reserves. At least that property had some reserves, about 3 months of operating expenses. Ideally, I want to see 6 months of operating expenses and debt service, or at a minimum 6 months, maybe for a newer property. The number could be a little bit more flexible, but that's your rainy day fund, right? So unless, again, you're comfortable with a scenario where you're financing some of those items out of cash flow, or in the event, in this case, the OPEX reserves are really designed to cover you during cash flow compression or potentially negative cash flow periods. So if those continue for a prolonged period of time, that typically would result in pause of distributions and eventually in a capital call. So if you're comfortable with that risk, then going in with no or low reserves is one option, but that's a an item I raised to that investor's attention, again, to better understand, tied to that operator's operational track record, and ultimately decide for themselves, are they comfortable with that? And so all in all, when you make these adjustments and this deal turned from high double digits to a low double digit slash high single digit return, again, assuming you believe those adjustments reflect a more realistic base case scenario. And so then as an investor, right, you have to make a decision, am I comfortable with this overall return or not? So hopefully that's helpful for you. Let me see if there are any questions in the chat. And if you do need help with a deal review, that's certainly something that I can help with. Like, I've helped many active and passive investors. And the case study that I shared with you today is from a capital allocator who was needing that second set of eyes. And in prior live events, I did share case studies from passive investors as well. So simply send me a DM. I have opened up a couple more time slots for this month, and certainly happy to take a look, have a discussion, and if that's something I can help with, I'm pretty quick to tell you yay or nay and define the timing expectations. So again, thank you so much for joining in today. I really appreciate your engagements, all of your questions and DMs. And if you'd like to be notified of future live events, simply follow me on LinkedIn and YouTube. If you're not subscribed to the YouTube channel, I have a ton of content, complimentary content and educational videos there. So I encourage you to subscribe and hit that notification button so you can get access to those videos first. And I look forward to seeing you again at the next live event next week. Ciao. Oh, thanks, Ken. I appreciate you. Thanks.